Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today we're asking, $113 oil traps the federal stagflation is here. Versus $113 oil is the top. Sell the war premium. Let's hear from the hawk and the contrarian.
WTI crude jumped 13% to $113.08 on April 2 after President Trump's war address offered no off-ramp from the Iran conflict and promised 2 to 3 more weeks of strikes. That single session erased any remaining illusion that this energy crisis is temporary. The math is brutal.
WTI crude hit $113.08 on April 2, up 13% in a single session, up 58% since early February. The financial media is running 1970s stagflation comparisons. Energy Twitter is calling for $150.
Every previous oil shock left Hormuz open. The 1990 Gulf War, the 2003 Iraq invasion, the 2019 Abqaiq drone attack, none shut the strait. This time it is closed, and Trump's April 2 speech made clear it will stay closed for at least 3 more weeks.
The market is pricing oil as if the Strait of Hormuz stays closed forever. It will not. Trump's April 2 speech was hawkish, but read past the rhetoric.
The Fed cut rates from 4.09% in October to 3.64% in March on the assumption that inflation was trending toward target. That assumption just died. Energy accounts for roughly 7% of CPI directly, but its second-order effects ripple through food, transport, and manufacturing.
The IEA has already begun coordinated releases. The combined strategic reserves of IEA member nations exceed 4 billion barrels. The US SPR alone holds roughly 370 million barrels.
Every $10 increase in crude costs American households roughly $120 billion annually in higher gasoline and heating costs. WTI has risen from the low $70s in early February to $113, a $40 move that translates to nearly $500 billion in annualized consumer drag. This is not theoretical.
The 1970s had 4 things today's economy lacks: wage price spirals, union-dominated labor markets, gold standard hangovers, and no domestic oil production to speak of. None of those conditions exist in 2026. The Fed funds rate at 3.64% is restrictive by modern standards.
The contrarian case rests on geopolitical premiums fading. They are wrong this time, because the supply disruption is physical, not psychological. Iran produces roughly 3.2 million barrels per day.
6 major geopolitical oil spikes since 1990. Average duration of the premium, 11 weeks. Average retracement, 40% of the spike within 90 days of peak.
Overweight energy. Exxon, Chevron, and ConocoPhillips have mid-$40s breakevens and are printing free cash flow at these prices. Underweight consumer discretionary, airlines, and anything with thin margins and high fuel input costs.
Short the war premium. Underweight energy producers trading at cycle peak multiples. Overweight the consumer discretionary and travel names getting crushed by $4 gas. They are the ones that bounce 30% when oil drops back to $80.
The $113 oil print is not noise. The Strait of Hormuz is physically closed, Trump has signaled weeks more of military operations, and the Fed is frozen at 3.64% with no room to cut into a supply-driven inflation shock.
Oil at $113 is the panic peak, not the starting gun. Every data point the hawk cite, Hormuz closure, Trump's rhetoric, $3.99 gas, is already in the price. 2 very different takes. The hawk and the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.